The 1% control $32 trillion while you scrape together pennies. Nobody is telling you this. They never spend their own cash. Wild, right? You were taught debt destroys and savings save. Complete lie. They weaponize borrowed billions while you stay broke. This is not theory. Federal Reserve confirms the top 1% own more than the bottom 90% combined. Forbes reports 400 richest Americans hold $3 trillion. Here's the kicker. 90% of their wealth came from leverage, not paychecks. That gap exploded $2 trillion since 2020. Not happening in 20 years. Happening right now. In this video, I am going to expose their buy borrow die strategy step by step. You will see the exact math billionaires use to live tax-free forever. I will reveal the legal structures protecting their assets from lawsuits and the IRS. And you will get 5 specific steps to start borrowing like the wealthy this week. But first, let me show you the pattern they hide. Warren Buffett sits on $160 billion in cash, yet borrows billions more at 2% interest. Why spend 0% money when banks pay you to borrow? Here is the math. Borrow at 2%. Invest at 12%. Keep the 10% spread forever. Banks love this because the collateral never fails. But here is what should terrify you. You pay 6% on mortgages. They pay 2% on skyscrapers. Let me show you the smoking gun. The average millionaire carries $4 million in debt. Not bad debt. Good debt generating cash flow. They buy apartment buildings with 10% down. Tenants pay the mortgage. Buildings appreciate 10% yearly. After 5 years, they refinance. Pull out original stake tax-free. Buy the next building. Repeat forever. 1 million controls 12 million in assets. But wait, there is more. This creates infinite leverage. 1 million equity commands 25 million real estate. That portfolio spits 3 million yearly cash flow. Services all debt and builds equity. Their original million compounds untouched at 15% annually. Most people blow cash on cars and vacations. The 1% buy empires with borrowed money. Schools never taught you this. You might think this sounds risky. Here is the twist nobody sees. They eliminate risk through structure. Every deal lives in its own LLC. Family trusts protect personal assets. Holding companies layer bulletproof protection. Interest payments, tax deductible. Depreciation creates paper losses. A 3% loan becomes negative 1% after tax benefits. They get paid to borrow. Now let me show you a real example. Take a typical 1% deal. Buy a 20-unit building for $6 million. Put down $600,000 from home equity. Finance the rest at 3% fixed for 30 years. Rents cover debt plus $40,000 monthly profit. That profit funds the next deal. Original stake? Never touched. 10 years pass. Rents rise 15% from inflation. Debt stays locked. Cash flow quadruples. Equity builds automatically through principal paydown. That is one building. Scale to 50 nationwide. For $100 million controlled. Millionaire status achieved without touching principal. But here is the part that should keep you up at night. Banks reserve their best rates for the already wealthy. You pay 6.8% on homes. They pay 1.9% on commercial properties. Why? Their advisors negotiate rock-solid covenants and guarantees. JP Morgan just launched $1 trillion in private credit exclusively for billionaires. That is their moat. Unlimited cheap capital. Your savings earn 0.3%. Theirs earn 28% leveraged. This is not competition. This is total domination. And here is the breakthrough nobody talks about. The Federal Reserve cut rates 5 times in 2025. 1% portfolios refinanced $300 billion. Saved $6 billion yearly in interest. You missed it. They capitalized immediately. This separates winners from workers. But do not worry yet. I will show you how to cross that line. Now let me show you their most powerful weapon. Stock market loans nobody talks about. The wealthy borrow against portfolios at 2% interest. Never sell a single share. They never trigger capital gains taxes. This is mastermind-level strategy. Imagine holding $10 million in Apple and Tesla stock. You need $2 million cash for a new investment. Most people sell shares, triggering taxes and losing hundreds of thousands. The wealthy pledge stock as collateral instead. Banks lend them $2 million at 1.8%. Their stock keeps growing while dividends cover the interest. No sales, No tax is triggered. That 100,000 saved compounds over decades. But here's where it gets even crazier. At death, the tax basis resets to current market value. Their heirs inherit with capital gains forgiven forever. This is the buy, borrow, die loophole in action. You, however, pay taxes on everything. They legally structure around it. Let's dive into the numbers. A billionaire owns $1 billion in stock, basis from decades ago, $100 million. If sold, a $900 million gain would trigger a massive tax. Instead, they borrow $300 million against it, paying only $6 million a year interest. Interest is deductible, saving $2 million in taxes. Net cost, for million. Stock grows 10% or $100 million annually. After interest, they are $96 million ahead without selling. When they die, heirs inherit stock at the reset basis. They can sell tax-free and pay off the loan, keeping the entire fortune. This should make your blood boil. Your wage is taxed relentlessly while their fortunes grow tax-free. The system is rigged from the bottom up. But wait, there's more. Real estate adds another layer of tax magic. When they buy a $5 million building, they don't just collect rent. They claim depreciation over 27.5 years, spreading out paper losses yearly. That means they write off huge expenses on paper, even as the property's market value rises. These paper losses offset their taxable income, sheltering cash flow from Uncle Sam. Fast forward 10 years. The building doubles to $10 million, loan balance falls, cash flow grows. Do they sell? No. They refinance at 70% or $7 million. They pull out $2 million tax-free because loan proceeds are not income. Depreciation continues on original cost, allowing infinite tax-free cash extraction. Professional investors stack these moves across multiple properties, generating phantom losses that offset salary and dividends. Their effective tax rate is often zero while net worth explodes. Meanwhile, Uncle Sam pockets nothing. You can start small with the same playbook. Need $50,000 for your first rental? Borrow against your 401k at prime plus 1%, currently about 6%. Interest pays yourself, buy a cash flow property, and rent covers your payments plus profit. Use a HELOC for your down payment on a triplex, live in one unit, rent the others. Tenant rent covers your mortgage completely, freeing your cash flow to build equity and buy more assets. Another trick is seller financing. Find a motivated seller willing to carry most financing at low rates. Put down 10%, have the seller finance 70% at 4%, and the bank only 20%. Minimal cash needed, control entire asset, collect cash flow from day one. Seller gets steady income, you build your empire. Stack these strategies in 12 months to control $200,000 in assets starting from nothing. Remember, only borrow for assets that pay you more than their cost. Borrowing for cars, watches, or vacations is financial slavery. The wealthy borrow to build cash flow assets. If you break this rule, you lose. Here's how the perfect deal looks. Buy a $400,000 property with verified rents covering expenses plus 10%. Put 20% down, $80,000. Finance rest at 6% interest. Collect $3,000 in rent. Pay $1,900 in mortgage, $600 in insurance, tax, and maintenance. Net cash flow $500 a month or $6,000 a year on $80,000 down. That's 7.5% cash on cash return plus appreciation, principal paydown, and depreciation for a real total over 20%. Repeat until you build wealth. Subscribe now before I pull back the curtain on offshore secrets the ultra-wealthy use to vanish cash legally. You need to see this today. Time is running out. By now you have seen how the wealthy borrow instead of sell, and how they legally sidestep capital gains. Now it is time to step into the darkest part of their playbook, the offshore fortress where money goes to disappear from the tax man. The ultra-rich are not just using clever deductions at home. They are quietly routing oceans of cash through jurisdictions that barely tax anything at all. Imagine an entire network of shell companies, family trusts, and holding entities scattered across tiny islands and discrete European banking hubs. On paper, these places are just friendly business environments, but in reality, they function like invisible vaults for global fortunes. Some of the most famous tax havens openly advertise zero tax on income, zero tax on capital gains, and extreme privacy. Combine that with strong legal systems, and you get a magnet for hedge funds, tech founders, oil magnates, and dynastic families. Here is how the game works in simple terms. A company or individual sets up an entity in a low-tax country and then shifts profits there through internal pricing tricks and licensing deals. Instead of booking profit where it is actually earned, they pay inflated fees, interest, or royalties to their own offshore entity. Those payments show up as expenses in a high-tax country and as lightly taxed income in the haven. The result is brutal for everyone who plays fair. Governments lose billions in revenue while workers and small businesses are left to fill the gaps with higher taxes and fewer services. And it is not just corporations. Wealthy individuals can park investment portfolios, yachts, and even intellectual property in these structures to bury both ownership and tax exposure. Legal vehicles like trusts and foundations add another layer of armor. On paper, the trust owns the assets, not the individual, which makes it much harder for tax authorities, ex-partners, or creditors to reach the money. The most aggressive setups thread together multiple countries. One jurisdiction provides secrecy, another offers zero tax on certain income, and a third supplies favorable treaties that prevent double taxation. By the time the money reaches its final destination, it has passed through so many hands and rules that nobody can easily tell where it should have been taxed. Even when new transparency laws and information sharing agreements kick in, the system is always a few years behind the sharpest lawyers. So where does that leave you? Because if you are watching this, you are probably not wiring hundreds of millions to the Cayman Islands this week. The point is not that you should copy the most extreme offshore stunts. The point is that you must stop thinking like a wage earner who only reacts to tax bills after they arrive. The wealthy start every decision by asking one question: how do I own and structure this in a way that keeps the most after tax? You can do a smaller, cleaner version of that right where you live. Using simple entities like LLCs, closely held companies, and basic trusts can already improve how your income is taxed and how protected your assets are. You do not need secrecy or exotic islands to benefit from better structure. You need education, planning, and professionals who understand both tax law and asset protection in your own country. In the next part, you are going to see exactly how to assemble a mini fortress that an ordinary person can actually build. Not a billionaire's spider web of islands and flags, but a realistic stack of accounts, entities, and habits that change your trajectory over the next decade. We will walk through how to separate your personal life from your business life, how to route cash flow through vehicles that give you flexibility instead of trapping you in a high-tax paycheck box. Most importantly, you will learn how to stop playing defense one tax bill at a time and start playing offense with a plan that quietly compounds your advantage year after year. Because once you see how much of the game is decided before a single dollar even hits your bank account, you will never look at a simple job plus savings account strategy the same way again. You have seen how the giants play the offshore game and bend the tax code like warm metal. Now it is time to talk about what you can actually do, starting from a normal income, in a normal country, with real-life responsibilities. The first shift is brutal but necessary. You must stop thinking of yourself as an employee who happens to invest and start thinking of yourself as a small financial entity that happens to have a job. Why does that matter? Because the tax code is written like a love letter to entities, not to paychecks. Companies get to deduct their expenses before paying tax. Employees get taxed first, and then are told to survive on whatever is left. So step one of your mini fortress is simple. You need a separate vehicle for your money life beyond your personal bank account. For many people, that is a basic limited liability company. You use it to receive side income, consulting fees, small business revenue, or content royalties. Income flowing into that entity can often pay for legitimate business expenses before tax hits. Education, software, travel, equipment, sometimes even part of your home office can move from after-tax pain to pre-tax investment if done correctly. This is not magic. It is simply using the same rules that businesses have always used while most individuals stay trapped in wage earner mode. Step 2 is separating your operating entity from your holding entity. Think of the operating side as where risk lives, and the holding side as where wealth sleeps safely. Your job, your freelance work, your store, your online brand. Those live in the operating bucket. Your investments, your rental properties, your long-term cash reserves. Those should increasingly live in a separate, quieter structure. In practice, that could mean one entity that runs your active work and another entity or trust that gradually accumulates the profits. The goal is that if something goes wrong in the active world, your long-term storehouse is not wiped out in the same storm. Step 3 is organizing your cash flow into clear lanes. Right now, your money probably crashes into a single checking account and bleeds out in 100 directions. Instead, you want 3 major lanes. A lane for lifestyle, a lane for operations, and a lane for long-term assets. Lifestyle is where your day-to-day spending lives. Operations is where business and career expenses are routed and tracked. The long-term lane is sacred. It is where you send a fixed percentage of every dollar into assets that spin off cash and grow over time. This is where you apply the debt strategies from parts 1 and 2 on a scale you can actually manage. You use smart leverage for rentals, small businesses, or income-producing assets inside the right structures. Step 4 is building your advisor triangle. You need at least 3 people around you who think in strategy, not just paperwork. A tax professional who understands business owners, not just employees. A legal mind who gets asset protection and basic estate planning. And a financial or planning brain who can help you map how income, assets, and goals connect. You are not delegating responsibility to them. You are hiring brains to help you think like the people at the top. Step 5 is brutally simple, and almost nobody does it. You review your structure at least once a year, as if you were the chief financial officer of your own family. Ask one question again and again. Is my current setup the most efficient and protective way to own what I own and earn what I earn right now? If the answer is no, you adjust. Maybe you move more activity into the entity, or turn a hobby into a business, or start a holding company to capture your growing assets. None of this requires being a billionaire. It requires accepting that the real game is structure first, income second. In the next part, you will see how to combine everything into a simple, ruthless checklist. A set of moves you can start this year to step out of the paycheck trap and into the world where your money finally works harder than you do. We have covered the debt strategies, the offshore secrets, and the fortress structures. Now we land the plane with the exact protocol you execute this year. This is not about trying harder. It is about installing a new operating system for your financial life. Here is your ruthless checklist to move from wage earner to wealth builder in 12 months. Phase 1. The structure shift, months 1 to 3. Form your operating entity. Stop accepting side income or freelance money into your personal name. Open an LLC or limited company this month. Get a dedicated business bank account and credit card. Everything related to earning that income, phone, internet, software, travel, gets paid from here first. Audit your personal cash flow. Review the last 90 days of spending. Kill every subscription and recurring cost that does not earn you money or keep you alive. Reallocate that recovered cash flow into your new holding lane. Open your holding accounts. Set up a brokerage account and a high-yield savings account in the name of your trust or holding entity if ready, or at least separate from your daily checking. This money is not for spending. It is for buying assets. Phase 2. The debt offensive, months 4 to 6. Execute the good debt pivot. Look at your current liabilities. High-interest credit card debt? Kill it immediately with the snowball or avalanche method. But look at your low-interest debt differently. Do not rush to pay off a 3% mortgage if you can earn 8% in a safe asset. Let inflation erode that debt while you keep your cash working. Acquire your first income asset. Use the leverage strategies we discussed. Look for a rental property, a dividend portfolio, or a small business stake. Use other people's money, bank loans, or seller financing to control the asset while putting down minimum personal cash. Remember the rule: if it does not pay you cash flow from day one, do not buy it. Phase 3. The fortress build, months 7 to 9. Hire your triangle. Fire your once-a-year tax filer. Hire a tax strategist who asks, how do we reduce your lifetime tax, not just how much do you owe this year? Find an attorney to draft a basic will and perhaps a living trust to keep your assets out of probate court. Automate the flow. Set up automatic transfers that move money from your operating entity to your holding accounts every single month. You should never have to decide to save. The machine should do it for you before you even wake up. Phase 4. The global vision, months 10 to 12. Plant a flag. You may not be ready for a Cayman trust, but you can open a bank account in a stable foreign currency or country to hedge against your local economy. Or simply invest in international index funds that own the best companies outside your home borders. Do not have 100% of your future tied to one government's decisions. The CEO Review. Schedule a full day at the end of the year. Review your balance sheet, not just your income statement. Did your net worth grow? Did your passive cash flow increase? If not, adjust the machine. The final warning. Most people will watch this video, nod their heads, and do absolutely nothing. They will wake up in 10 years with the same job, the same taxes, and the same complaints. Do not be that person. The system is rigged, yes, but it is rigged in favor of those who build structures, use debt, and think in decades. You now have the map. You know the secrets they tried to keep in the dark. The only variable left is you. Will you stay a victim of the system, or will you build your fortress and master it? The clock is ticking. Your move.